Hello everybody, welcome back to the channel, and this is again Anti-Tax Avoidance Directive, German Foreign Relations Tax Act and related topics. And today let's talk about CFC legislation, that is the taxation of controlled foreign companies. Well, and naturally the first thing we should try to understand what it's all about. So what is the problem that these special rules want to deal with? Okay, so let's talk about that problem. Most states of the world have a system of a worldwide taxation. That is something which you know. Approximately 90% of all states and territories worldwide which levy an income tax have a worldwide income taxation. Now, naturally, taxpayers try to avoid this. And so how can you try to avoid unlimited tax liability, or at least the consequences? The first and most simple approach is move away. So just shift your residence to a country where taxes are lower or where an unlimited tax liability does not exist or so. Now, in many cases, you are not willing to leave your home country. So what can we suggest to these people? Well, the other alternative is avoid the worldwide income, become poor, at least for tax. Avoid to have any income. That's the only other possibility which you have if you want to avoid taxation under unlimited tax liability. Either don't live in the inland or don't have a worldwide income. So get rid of your income would be the recommendation for the people who want to stay in the inland. Now the question is, how can that be done? Spending every income in a casino is not helpful because that is not a deductible expense. You know that. So you would have to even prevent that your income arises at all. So there should be no income from the beginning. What can we do? Well, let's look to the situation of the average rich person. This is here Mr. Rich, lives in Germany and has income from different sources. First, patent rights, then interest from bank accounts and credits, then rent for real estate located abroad. Everything of that is taxable worldwide income. Now, 3 million. What can Mr. Rich do? Now, Mr. Rich wants to get rid of his whole income. So what he does is he transfers all his property to a foreign company abroad. Now here we have the foreign company. The foreign company is now the subject which achieves all the income. So the patent rights, the interest, and the rental income in the future flow to the foreign company and no longer to Mr. Rich. The foreign company has 3 million now, Mr. Rich has 0. The only income which Mr. Rich could have is dividend income, but surprise, the foreign company owned by Mr. Rich never pays a dividend. Why? Well, who decides on that? Mr. Rich, the shareholder assembly. And Mr. Rich, for unknown reasons, never claims a dividend. He regards it as far more promising to keep the money stored in the foreign company. Now one could reproach him, but you could have dividends, so you could be richer than you are. But fact is, you are taxed on the income which you have and not the income which you could have. If ever a member of the fiscal administration reproaches you that you have so low an income, just counter that by the question, you are such an expert, do you know how much more you could earn if you changed the job and changed over to a tax consulting firm? Then the fiscal officer will probably have an insight. No, will probably accept, okay, we are taxed on the money which we have and not on the money which we could have. Here are no dividends, or nearly no dividends. So that means Mr. Rich has effectively gone rid of his worldwide income. That is the underlying problem. By this construction, Mr. Rich can easily end up having no income from other countries of the world at all. And the richer Mr. Rich is, the more Mr. Rich lives from income from property, and that can always be brought into the hands of a foreign company. So naturally, the company which you choose for that model must be foreign, because if it has a place of management or seat in the inland, you would just replace the unlimited tax liability of Mr. Rich by the unlimited tax liability of that company. That is not what you want. By the way, from time to time, exactly that happens, because when you then investigate into the nature of the foreign company, sometimes you get the answer, well, there is a managing director abroad, but don't worry, it's no risk. In all situations where that person has to take decisions, the manager has to call me. So the place of management where the real decisions are taken is then in the inland, where the shareholder lives, because the shareholder takes all the decisions of everyday life investment, and that would ruin the whole model. So you must take care that your company is really a foreign one. Now, if the income of that foreign company comes from Germany, it could perhaps at least be taxed in Germany under limited tax liability. So you try to shift your sources of income abroad. Or you can at least run that model with all the income which is not from Germany. So final result of the construction is, if you do it properly, due to the nature of a capital company under civil law, Mr. Rich has no income anymore. Mr. Rich is now, for tax purposes, Mr. Poor. Furthermore, international public law has interesting ideas and principles. There is a basic principle of international law which says no state is allowed to extend its legislation to things which have no connection with that state. So you could happily bring forward that international law prevents Germany or any other state from taxing the foreign income of a foreign company, because that has nothing to do with the inland, neither the person nor the event. And that's then really hard. So if you see that possibility, what does that imply? Well, that does mean, as everybody can easily do that the principle of worldwide income taxation can easily be brought down completely. It breaks up into pieces, can't be saved if you don't have a really good idea. So naturally, when you see that the construction with a controlled foreign company, which you place in between you and your sources of income, that this construction brings down the whole logic of your tax system if you tolerate it as a state. So what can you do against it? Well, the first thing is you will desperately try to find a solution and not tolerate that. So now, which countermeasures can you take? Well, the first thing is you could just drastically say, okay, this is a foreign company, but in case of a foreign company, we don't treat it as a company, we treat it as a partnership for taxation, and therefore we tax the share of Mr. Rich in the company's profits directly, immediately when they arise, and so the share of Mr. Rich in the foreign company's income is regarded by us as his personal income. Now, the problem with that approach is the foreign company is not a partnership, so it would be a kind of a fiction on which you base yourself. That fiction would be discriminating because foreign companies are always treated as partnerships, inland companies are not. You promised in all your double taxation treaties that you are not going to discriminate against foreign citizens, and I may suppose that also could be interpreted that it covers foreign juridical persons too, that you are not going to discriminate against foreign citizens. Shit. So that could bring along discussions, and judges might come into play. And sometimes there are strange judges, people who have, although they have been educated to study law and practice as lawyers, or have practiced a long career in the state administration, that they still have preserved some basic feeling for justice and fairness. And so they would probably deny to follow that fiction. So that's rather risky. Furthermore, if you treat a foreign corporation as a partnership, well, very often the foreign income would be you would have to treat it under the rules of a double taxation treaty. So imagine you say that Mr. Rich and not a foreign company earns some patent right from abroad, or earns some real estate income from abroad. You would probably have to apply a double taxation treaty, which then precludes taxation. Far too risky, too, and complicated. That makes things complicated. So is there any really basic approach which helps you and which is foolproof? Some states, I think the first ones were the US in the 1970s, had a really great idea. The idea was, we do not tax the foreign income of the foreign company. We would never do this. We just tax another income, an invented additional income of Mr. Rich. So we don't tax the income which really exists, which is foreign, of a foreign company. We tax Mr. Rich with an invented amount, and this invented amount is just by coincidence, by a systematic coincidence built into our system, exactly as high as the foreign income of the foreign company. So that's a trick. That solves all the legal problems. No violation of international law. Because you don't tax foreign income of a foreign company, you tax an income which does not exist at all, and an income which does not exist cannot come from abroad. So you can't violate the rights of foreign states. You also have not to respect any limits of international law. It's not foreign. Second, you probably never signed a double taxation treaty where you entered an article, non-existing income can only be taxed in the source state. By the way, it would be a contradiction in itself. If it does not exist, that income, it can't come from another state. So absolutely risk-free, that solution. If you closely inspect the double taxation treaties, there you even see there is an Article 21 which says all the income which has never been mentioned in one of the previous articles can only be taxed in the state of residence of the taxpayer. Translation: as you have never mentioned any non-existing income in the headline of one of the articles before, non-existing income can only be taxed in the state of residence of Mr. Rich. So even all our double taxation treaties give us the full right to tax the non-existing income of Mr. Rich. Okay, this is not strictly fair. It's a trick. But on the other hand, in international law, if it's not EU law, there is in general the principle that what a state did not explicitly promise is not promised, so that if we never wrote something which forbids us to tax non-existing income, we never promised not to tax a non-existing income, plain and simple. So no international treaty will preclude us, forbid us from taxing non-existing income. It is a really great idea. By that legal trick, we can now counterattack the trick which the taxpayer played on us. Mr. Rich made himself poor on paper artificially by clever application of the rules of civil law and company law. This is no longer my income, this is the income of the FC, foreign company. And now we say, well, Mr. Rich, we pity you so much that you have become so poor now. We can't really stand that feeling. It's so an intense pity which we feel for you that we really can't stand it. So at least on paper, we make you rich again. We invent for you some 3 additional million of income because we pity you so much. Now we are glad because now, due to our fiction, you are rich again. Congratulations. And as you are rich again, we claim a tax from you. That's now the natural consequences. So the taxpayer plays a trick on us with civil law, juridical person's nature, and we play a trick with him on the basis of the fictions of tax law. Nobody prevents us from taxing a fictitious income. By the way, that is really not a surprise. There is a long tradition in many states to tax a fictional income. For example, until the middle of the 1980s, I believe, it was customary in Germany that the owner of a house who lived in his own house was treated as if he had rental income from that house. So as if you had rented your own house to yourself. The idea was, who is owner of an own house saves the rental expense for a flat. And so his financial or her financial situation is better than of those people who have to pay rent. And in order to take that into account, by fiction, the house owners were treated as if they paid rent as a private person to themselves as a house owner, so they had revenue from lease and rent. That was later abolished because, Germans always try to minimize their tax position. So the German house owners usually manage to have far higher deductible expenses in connection with this rental expense than they had to pay taxes on. So they always took great care that they could produce losses from lease and rent from their own houses by repairs and other things. And so that is why the state here later abolished that. But it's a generally accepted idea that the state can freely define the income of a taxpayer, and that one can also tax an invented income, a fictional income, which only exists in the fictitious world of tax law. So what we do here with Mr. Rich is absolutely legitimate. Not nice, but from the formal legal point of view, it's absolutely okay and traditional. Now, what we must keep in mind, that is that our basic approach is we want to have this model as a legal countermeasure against Mr. Rich's tax saving model. So if Mr. Rich uses foreign capital companies as shield against taxation, then the technical term for this legal countermeasure is usually the CFC legislation, controlled foreign companies taxation. This does not really mean every foreign company which you control is taxed under that rules, but only the tax-saving constructions. And generally speaking, it's CFC legislation that only means or applies to tax-saving constructions in the basic meaning. Furthermore, if you concentrate on German legal language, there is also to be found the term intermediate company, or in German original language Zwischengesellschaft, which reflects the notion that the taxpayer, here Mr. Rich, placed a company between himself and the income. That's why it's called intermediate income. Intermediate company, you placed it between yourself and the sources of income in the middle to shield you against the income under civil law. Well, so that's the basic idea of CFC legislation. Taxpayer plays a trick with civil law. We play a trick on taxpayer with tax law. We just do as if you were rich. We invent an income again for you so that you got rid of 3 million on the one hand, and we gave you 3 million which do not exist into your other hand and now charge you with tax on these fictitious 3 million. And we feel good, we never violate any international obligation. That's the trick. Now let's come to the details. If you really follow that basic idea, then you must decide upon some details which profit, for example, shall be taxed under that countermeasure. Our first conclusion should be we are going to find a tax-saving model. So it makes only sense to apply our countermeasure, the CFC legislation approach, to income where the tax paid by the foreign company is lower than it would be in the inland. You can't really bring forward that if Mr. Rich is the owner of a foreign company in a country where 50% tax are taken, far more than here, then you can't really fear that this is a tax-saving model. Here, the participation in the foreign company will have genuine economic reasons. One should respect that, or at least nothing need to be done. Good. So the first idea would probably look to the tax which is paid by the foreign company. Is it relatively low so that it could be a tax-saving model, or is it higher than in the inland, because then there must be a genuine economic motive to set up this foreign company. So if you just want to defend the worldwide income principle against being turned into nonsense, then you could restrict yourself with a good conscience to just fighting those foreign companies where you have a low taxation. So you will have to determine where a low taxation begins, or where the foreign taxation is, from your perspective, high enough to exclude the idea that you deal with a mere tax-saving construction. Yeah, so then, as you have seen, the effect of an intermediate company is under civil law that the income of that company is no longer the income of the inland taxpayer, but now belongs to the company. Now, if the foreign company pays dividends, then the taxpayer naturally again has income. So a tax-saving effect is perhaps only there as long as no dividends are paid out. That is the question. Is that really true, or is that a wrong conclusion? And that entails a question. Should a CFC legislation only tax undistributed profits until they are distributed? So shall it only bridge the time gap? Or should it tax all profits which are made by the foreign company even if they are paid out later to the shareholder as dividends? And the answer depends on the system of dividend taxation in the taxpayer's country. There are basically internationally two ways how dividends can be taxed. The one way is a classical corporation tax system. There's one tax on the corporation tax level, and later, when the dividend is paid, a second tax arises on the shareholder level, and the two taxes have no connection. Very often, the tax rates are then not the full rates. For example, the German income tax rate goes up to 45%. But if you have the German corporation tax system, then you have 15% plus trade tax on the company level, and later 25% on the dividend level. And so the taxation of the dividends is always 25%, and nobody cares about how high or low the corporation tax level has been if the dividend comes from abroad. So in such a system, if you can avoid corporation tax by placing your company abroad, where there is a lower corporation tax than in the inland, you still have a definitive financial advantage, even when the profit is paid out as a dividend, because the overall tax burden if the dividend comes from a low tax country is then far lower than case of an inland investment. So as an example, if you have corporation X making a profit of 1,000 and that pays a corporation tax of 25, then they pay 250. The remaining amount can then be paid out as a dividend, 750. And now if you have to pay personal income tax on that, let's say 40%, then you would have to pay an additional 300. Now it's clear if you only pay 1% corporation tax and then pay 40% on the dividend, the total tax burden would be far lower. Now there is a second system, which if you come from Germany is not so familiar to you. That is taxing dividends under the indirect tax credit scheme or system. That means the taxpayer has to pay a full corporation tax rate if the taxpayer is a corporation, or the full personal income tax rate. But the corporation tax already paid by the company which generated the underlying profit is credited to the tax payable by the shareholder. For example, corporation Y makes a profit of 1,000. Now it pays a corporation tax of 25, 250. Now the remaining amount can be paid out as a dividend, 750. When it is paid out, now the tax already paid by the lower tier corporation is credited in favor of the taxpayer. So the taxpayers, the dividend recipients' income is therefore computed as cash received 750 plus credited amount of 250 is 1,000. The personal tax rate of the taxpayer is applied, let's say 40%, 400. The tax already paid by the corporation is deducted, credited. So minus 250, and the shareholder then pays 150. Now it is clear in such a system, if the foreign or the corporation tax paid by the lower tier corporation is lower, then the credit just is lower. For example, then you just get credited 100 or €1 or so, but the total amount which you pay on the original profit will always be 400. So in such a system of an indirect tax credit, there will be no problem when the dividend is paid. Then every tax advantage of the foreign corporation is automatically removed. So there you only have a temporary advantage if you place your sources of income into the hands of a foreign corporation. Naturally, if you, like our Mr. Rich, nearly never pay out a dividend, then temporary advantage can last very, very long. So you will have to bridge the gap by an additional tax, like a CFC tax, but then you can limit that for the time during which the dividends are not distributed yet. On the other hand, in a classical system, you would achieve a definitive advantage, and so there the effect of a CFC tax would have to be definitive in the long run, even it should still keep effect when the dividends are distributed. So that's clear. So, in an indirect tax credit system, the advantage of a lower tax level automatically ends at the moment when the foreign income is distributed as a dividend. So, the taxpayer here in my example, let's say, has established a corporation in a tax haven where the corporation tax rate is only 1%, so pays only €1. Then if that corporation earns 1,000, they only pay a tax of 10. 990 can be paid out as dividend. The income is for the dividend recipient under the indirect tax system, indirect tax credit system, sorry, so much time must be available. The income is then 990 in cash and 10 in form of a tax credit, so revenue is 1,000. The personal income tax is 40%, 400, so 10 are credited, so the remaining tax should be paid at home is 390, and the total tax burden is again 400, as in the inland case. So no risk for long-time consequences of such a foreign controlled company. Now, that means if your dividend tax system is of that nature, then the tax advantage from establishing a corporation is only given for that time until you distribute the money as dividend. So if you want to fight the tax saving model, you should restrict yourself to amounts which are not yet distributed as dividends. On the other hand, in a classical system, that's completely different. For example, the present German system shows you that if the shareholder is a natural person and the profit is invested, the profit is 1,000, the tax from abroad is 1%, but in the inland is 15%, then you have a difference. The net amount which can be paid out as a dividend is 990 in the foreign company and 850 only for the inland corporation. We have in that example ignored trade tax just for reasons of simplification. Now the total amount, the shareholder level tax would be 25%. So that is in the foreign company's case 247.50. In the inland case, 212.50. The total amount of taxes shows extreme differences to 257.50, or in the inland case, 362.50. So you have over 100 units, which are not only temporarily but permanently saved in form of a tax saving effect. So here you would have to behave differently. If the shareholder in Germany is a company itself, then due to the 8B KSDG privilege, the effect is even more drastic, because then you have the foreign company paying 1%, the inland company paying 15%. The shareholder level tax is in both cases 0 under 8B KSDG if you hold a major participation. So here you have a drastic deviation between difference between the two total tax amounts. Yeah, that allows the following conclusion, which you already must have grasped on your own until now. In a country where dividends are taxed under an indirect credit tax system, CFC legislation is only needed to bridge the time gap between profits made when they are made and when they are distributed. In a country where dividends are taxed under a classical system, you need a CFC legislation even for those amounts which are immediately distributed and paid out as dividends. Because here the CFC tax must have even a permanent effect in order to equalize the tax saving effect. That leads to completely different approaches which countries have to choose depending on which dividend taxation system they follow. Well, the next question which you have to solve when you address or want to design your CFC legislation is we want to cover only those things where you have a tax saving effect. So which income can be regarded as going back to tax saving models? Well, that's a question. So let's think about that. CFC legislation definitively is not useful or makes no sense where the income from abroad is evidently not from abroad because of a tax saving model, but a genuine economic activity where you need for economic reasons the foreign location. Imagine you have a gold mine in the other country. Nobody would ever bring forward seriously that the gold mine has been sourced out to the other country because that other country is so low in tax. The gold mine is in the other country because the gold is there in the first place. And nobody ever would seriously bring forward that this is just an activity to avoid inland activities, a tax saving model. Very often you have other entrepreneurial activities where you can say the difference between getting active in the foreign country and becoming active at home is so enormous that it will not be the tax rate or the tax difference which caused your decision to place your investment abroad. There is, ladies and gentlemen, an enormous difference between a steel factory in the inland and a steel factory in the Antarctic. So completely different surroundings, different conditions, different working conditions, different labor law, and so on, all that. So very often there are activities where you can reasonably suppose these activities are not shifted abroad and placed in the hands of a foreign company just to avoid the inland taxation. Furthermore, it would naturally make no sense to shift your income to an intermediate company if the income is already tax-free in your own hands. So if a taxpayer has income from abroad and this income is exempted at home under a double taxation treaty, it would make probably no sense to include it or to shift it to a foreign corporation in order to save taxes. Okay, so the question is now which activities could give rise to a tax saving model and which activities exist where you can be reasonably sure that this is not suspicious of being a tax saving model. The problem here is if you design a law, if you draft the text for a law here, you need a solution which basically includes all potential tax saving models for all of the future. So you need somebody who is very, very clever in foreseeing what people might find as loopholes in the tax law. And what you need is, if you want to design a proper CFC legislation, a comprehensive list of all potential activities where tax saving models could, in theory, be possible. That is an enormous challenge because you would have to foresee every clever idea of the future. Just to make a list of the existing tax saving models makes no sense, because in the course of time somebody will find a new idea and then your law is not able to cope with that. So you need to foresee all potential ideas of tax saving constructors. So several approaches exist. The first idea is make a list and hope that it is as complete as possible. That doesn't work. I just talked to you about that. You will not be able to foresee every clever idea of people in the future. You could make a general clause which declares CFC legislation as applicable in all cases where taxation has played a major role in the decision to place the investment abroad. So ask for the motive. The problem is, if the motive is that what counts, then a good tax advisor will always find ways to find another motive, and to demonstrate that the real motive is an economic one and that the tax saving effect is just taken and accepted by chance. This is rather coincidence and follows from entirely different motivation. So that will probably not work. Somebody who is clever enough to look through the rules of international legislation is also clever enough to generate convincing motives. So forget about solution number 2. Number 3 is make a list which is really comprehensive. That would be great, but how can it be done? And here, at least the person who wrote the German law from 1972 had a really great idea. That person made a list of all the activities which can be accepted as non-suspicious, and then automatically said everything which is not on that list stinks, and therefore triggers CFC legislation. So they said we make a list of things which we accept as probably driven by economic motives, that is the so-called active activities. And all the rest which is not on the list is passive, and every passive income is subjected to CFC legislation if it is lowly taxed, naturally. Well, that was the nice approach in the 1970s, and that's really convincing. The problem is there might show up in the course of time further activities which one has overlooked, which are genuinely driven by only economic motives, so that your list of active activities is too short. But nevertheless, even if that happens, your list of potential tax saving constructions is always complete. So your system can fulfill its purpose. Now the next question you have to ask is, with whom do we play that game? Do we only take 100% participation, or will the CFC legislation already be triggered if you have one single share in a foreign company? That has to be decided. Now begin with the most convincing idea. We play that game only with people like Mr. Rich, who holds 100% of a foreign company. That is completely senseless, because then Mr. Rich will give one single share to somebody else and will be out of scope of CFC legislation. So we would probably have to go down to 99%. The counter reaction of Mr. Rich would be 2% of the shares are given to somebody else. So probably you can go down with the limit as low as you want to. You always have the problem. You can avoid that limit to take effect just by leaving one share out. A major problem only arises if you set the limit lower than the majority. Now, if you set the limit at the majority of the voting rights in the foreign company, then you can also circumvene that rule. Just two shareholders work together. You want to avoid taxation of your foreign parts of income. I want to avoid that too. We are good friends, so let's establish a foreign company in a tax haven together. I take 50% of the voting rights, you take 50% of the voting rights. Nobody of us has the majority, but nevertheless, nothing will happen. You can't vote me down, I can't vote you down. We will have to agree on common decisions, and that's it. So nothing will happen in the foreign company which we don't like. Yeah. So majority vote can also be avoided if you restrict yourself to people who have the majority in a foreign corporation. Then you can nearly forget CFC legislation. You can avoid it too simple. That also will not work. So what else can you do? The German legislation, which is still in force now in the middle of 2021, focuses on the fact if the majority of shareholders are from the same country, from Germany. Then the idea is if at least the majority of the voting rights is held by Germans or controlled directly or indirectly by German taxpayers, which, as you always know, means taxpayers who are subjected to German unlimited tax liability. The nationality is not what plays a role here. If the majority is held by people in your own country, then you could say, okay, then my shareholders can always, by their majority of the voting rights, take care that the foreign company must pay a dividend which is sufficient for the shareholders to pay the tax, the CFC tax, so that they don't get bankrupt because of their shares. Now the problem is, if your rule is there must be a majority of shares held by my own taxpayers, then your taxpayers, if they are not entirely stupid, might talk with people from other states. I am German, you are French, you are Spanish. What about setting up a foreign corporation together and everybody has 1/3 of the voting rights? So the majority is never held by shareholders in one single country. And surprise, we are out of scope of CFC legislation again. So you see that if we look to the participation thresholds, which we can imagine, nearly everyone can be circumvented. So even the majority of the voting rights held by several unrelated people in your own country is not safe enough to avoid that CFC legislation can end up useless. So if you only demand 1/3, then we all go down to 30%, 25, then we take 5 shareholders and 4 of them have 24.9, 10%, then we take up 11 shareholders, 1%. Then we organize via the capital market that 101 people join with equal percentages in the company, and so nobody has more than 1% or 1%. So you can always avoid, if you organize things a bit, that such a threshold is really fulfilled and applies. So you could even go down to 0.9% if 1% is the threshold. So if you really want to design a CFC legislation in a way that it can't be avoided artificially, then you would have to go down with the necessary participation to 1/3 single share in a foreign corporation. This, on the other hand, would be relatively unbearable because the lower your share, your percentage in the foreign company is, the more complications arise. For example, if you practice such CFC legislation, naturally you have to fill in a tax declaration, and in a tax declaration you have to fill out or communicate to the fiscal authorities your income, including your fictional additional income from the CFC company. So there will be an entry in the tax declaration where you have to check, do I have shares in a foreign controlled company? Yes or no. If you had to tick yes, then the next question would be, how high is the passive income of that foreign company? So you would have to call your foreign company or to read its financial reports in order to find out their income and to find out which of the income is active and which is passive. Then the next box will probably ask you, can you assure us that that figure which you gave us one box above is really computed according to the rules of German tax law? And then you begin to think about it. Where can I make sure that this figure, which I got from financial reporting, is really complying or in line with German tax law? And the answer is I can't. So I have to call them and ask them for the necessary data which I need to compute their tax profit according to German rules. Now imagine you have 1% in the voting rights. They will probably laugh in your face. On the other hand, if you get away with the argument, well, I called them and they laughed in my face, then it would be a relatively easy way to escape from CFC legislation. 100 shareholders join, elected managing director, and they take somebody who is sure to laugh in the faces of them if they ask for information. So the fiscal authorities will not be tolerating that. You will be forced to hand in such a tax profit calculation, or they are going to estimate this. So that's a bit complicated. More and more administrative burden comes into play the lower your participation is. Imagine you are the 100% shareholder, then one telephone call, I need these data. Okay, boss, you get it. 50% voting rights, I need some data. Okay, I'll do my very best, because the managing director knows he will need you in the future when a contract has to be prolonged. And even if you have 10%, it might be that somebody still reacts to your wishes. But then it gets more complicated. So you have to keep that also in your view when you design or when you decide about the threshold. So easily possible to obtain the necessary information if you have the majority. Similarly possible if a majority is held by people in the same country who all are interested in these data. Because if the managing director says nobody gets these internal data, then the German shareholders will take revenge in the next shareholders assembly. It will not re-elect that managing director. They have the majority, they all have problems with that which that director caused, so there will be revenge. If you have a very small participation, you can forget about this. So that also should play a role. And the problem is here you have a conflict of objectives. You want to function your CFC legislation properly. That means nearly one single share as the necessary quota. On the other hand, you want to function your CFC legislation properly under the who can obtain the information aspect. So you need to find a compromise between the administrative burden which you put on the individual shareholder and the effect which you have when you renounce on taxing everybody who has already a single share. So a compromise is necessary. By the way, there is another effect. The lower the participation of an individual shareholder is, the higher becomes the risk of such a shareholder to become a shareholder in a foreign company. If, for example, you hold a 50% in the foreign company, there will be nothing which you do not like. If you say they take over my patent rights, you don't have to worry what they do with that, and they will not do nothing against your interest. So if you, for example, need money to pay for your CFC tax, then they will pay out a dividend. If you hold only 10%, that's entirely different. Imagine if you place certain property into their hands in form of a contribution, they might later use it in a way which you do not like. And it might even be that they do not pay out a dividend which you might need to pay your German tax claims or tax claims from CFC legislation in your home state. So that might also bring along economic problems. Tax saving models now are usually only the ones where there is no economic risk. So the lower the participation becomes which you hold, the lower becomes the probability that it is a tax saving model where you are involved in. However, one could say that depends on the amount of risks which are combined with your activities. If, for example, under the statutes, the foreign company is only allowed to invest into AAA-rated treasury bonds of states, which are issued in your own home state currency, then there is nearly no risk at all. So you would probably agree to give your capital to such a company, even if you only hold one single share or 1% and so on. If, on the other hand, you own a patent right or a business concept and place that into the hands of a foreign company, and now the majority of the voting rights is held by others, then you place the power to decide what to do with that patent right into the hands of somebody else. And so it can probably later no longer be used in the way which you desired it or wished to use it. So that could spoil your fun in the tax saving model. And so it might depend on which income is in play. So when we look to the percentage of shares from which on a state wants to apply CFC legislation, there will be compromises. Compromises are always in a certain way arbitrary, so there is no one and only possible solution. There will be differences between the models of different states. A 100% successful prevention of tax saving models here, like Mr. Rich had it in mind, is only possible if you tax a single share. But with such a low threshold, the whole system will not be able to work in practice any longer due to the administrative burdens. So it will be somewhere in between, probably with an eye to which kind of investment is in play. Is it passive or is it really super passive, like in the case of the AAA investment, and so on. Yeah. Now, as we now have understood what the general framework is, which we need to have in mind when we switch to CFC legislation, naturally, then again, EU law restrictions come into play in the background again, because you remember there are these European Union fundamental freedoms, and they forbid any restriction of certain foreign activities. So, if an inland taxpayer holds a share in a foreign company, this taxpayer either makes use of his, her, or in case of company, its freedom of establishment. I have a majority or an important shareholding in a foreign company. I made use of freedom of establishment because it is a kind of my subsidiary. Usually you can say it is an entrepreneurial decision to hold shares if you have 25% or more, but sometimes that is even assumed when you hold 10% or 20%. Or it might be free movement of capital. You decide to contribute some 10,000 euro to a foreign company. So you move capital to a foreign place and invest it there. So this would always apply where the participation is not held by entrepreneurial motives. So where your participation is not made or held in order to grant you a substantial influence on the other company's decisions. It's either of the two. Now, to determine which fundamental freedom you made use of is decisive, because the freedom of establishment is not granted with effect to third states, third countries. It's only granted to enterprises which are in the EU, enterprises which are in the European Economic Area. You remember that's Iceland, Liechtenstein, and Norway. And to enterprises in Switzerland as far as natural persons are concerned. And that would also include the right of a natural person to set up a participation in a Swiss company if it brings along entrepreneurial influence. In all other cases, the freedom of movement of capital is granted unilaterally by the EU treaties, also with regard to capital investment and capital investors in third countries. At least in general. There is a standstill clause which says the member states and the European Union itself can keep up existing restrictions on certain kinds of capital investments, so not on all of them, which have already been used at the end of 1993 when that rule came into existence. But only as it is a standstill clause if the restrictions have been upheld unchanged since then. If new restrictions have been introduced, they do not profit from the standstill clause, so they have fully to comply with the freedom of capital rules. In addition to that, certain restrictions on the free movement of capital with regard to third states are allowed if the Council of the EU agrees to introduce them with a majority of 100% of the voting rights in the Council, and certain additional conditions of the treaty are fulfilled. So, restrictions, not always possible. What's a restriction of a fundamental freedom? Under constant jurisdiction, or standing jurisdiction, any measure which hinders or makes less attractive the exertion of one or all of the rights granted by a fundamental freedom. In that context, the question arises if a measure makes using the rights less attractive. How can we measure that? And that is usually done by comparison with the inland case. So if something in a cross-border context is less favorably than the treatment of the identical behavior in an inland case, that is an indicator for a restriction. Now, CFC legislation is applied to shareholders of foreign companies and never to shareholders of inland companies. So having to pay taxes on a non-existing income is clearly something negative, because it creates an additional financial burden, which in the inland shareholding case does not exist. At least if the effect is only temporary, like in an indirect tax credit dividend taxation system, at least then it at least creates a negative liquidity effect. You have to pay the taxes earlier than you would have done in an inland case. So this clearly makes a cross-border participation less attractive than a comparable engagement participation in an inland company. So CFC legislation, CFC taxation is clearly a restriction in the sense of EU law. That is unavoidable. That's evident, clear from the start. You can't get out of this. Now, naturally, you remember, I hope at least, that from the perspective of the fundamental freedoms, certain restrictions can be regarded as justified. But then they need to fulfill 4 requirements together. The first one was the measure must serve a legitimate aim of public policy. Here, CFC legislation wants to avoid the breakdown of the worldwide income system. So that is, I think, a legitimate aim. The measure must be able to reach the aim, at least in a sufficient extent. Number 3, the measure must not restrict the freedom in question more than necessary, so there must be no milder means to achieve that aim. And the measure must deal with the problem in question in a non-discriminatory way. That means you can't deal in an arbitrary way with the problems. So you can't deal with the problem very exactly in the cross-border case and then ignore the same problem in the inland case. Now, the conditions 2 to 4 are often nowadays summarized under the keyword of a restriction must be proportional to the aim in question. So the harmful effect for the freedom may not completely out of proportion to the importance of the aim which you want to achieve. That, by the way, that summing up these 3 last conditions under that headline gives a far higher discretion to judges, because now they can, according to their personal values or their personal discretion, decide that although something seems necessary, the impact, the negative impact on a fundamental freedom is far too high to be justified. Well, the European Court of Justice had already several times to decide on the compatibility of CFC legislation. The first decision was in Cadbury Schweppes. That was case C196/04. The court held in that decision that CFC legislation is indeed a restriction. Margin number 45. That setting up a company in another member state in order to profit from the lower tax level is not an abuse of a freedom. That is convincing because also in other fields of law, the existence of differences between the legislation of member states is just a natural consequence of the fact that the member states have still the right to make their own laws. And so if you take that as a pretext to deny the freedom of establishment, freedom of workers, and so on, that would have the final effect that until there was a full harmonization of every law in the EU, the fundamental freedoms could never have any direct effect. You could always talk yourself out of any obligation just by pointing to some difference between the home state legislation and the foreign legislation, and then calling it illegitimate to make use of these advantages of the foreign location. So that would deprive these freedoms of any binding effect. And that would be especially detrimental to the system of the free treaty, because there is a general consent since the 1990s that the EU is not even entitled to make a full harmonization of all legal aspects. So we would end up with a system of fundamental freedoms which would be turned basically into a sham. They would simply be only a pretext. Every state could talk itself out of any obligation. So the fact that the tax level in other states is lower can also not justify any restriction. So the court basically said there is no argument which could ever justify via such a restriction. The only argument which they opened for the member states was that the member states could say there are cases where the freedom of establishment has not really been used. So if it has not been used, then it does not come into play, and so the people are unprotected. And they said freedom of establishment means you set up a company in another state to have economic activities there. If you really did this, if you establish a company which has a genuine activity in the other country, then that company is fully protected. So what they said, if in reality the whole company is only an artificial construction without any reality in economy, then this can allow not to apply the freedom of establishment rules to that case, and then CFC legislation is possible. Now, concerning the freedom of capital, there was a recent decision from 2019, an unknown taxpayer acts against the German Finanzamt Stuttgart Körperschaften, where the European Court of Justice had to decide how CFC legislation can be compatible with the free movement of capital. And here the court underlined things like the following ones. The standstill clause in the EU treaty does only apply to direct investment, not to portfolio investment, so not to very small participations, number 28 in the judgment. That this clause does not apply to newly created rules, which was self-evident. That a CFC legislation applied to shares in a third country company is also a restriction to the freedom of capital. That an artificial construction is not protected by the fundamental freedoms, but that what is artificial in the context of the freedom of capital is different or can be different from what is artificial when it comes to judge if the freedom of establishment has been used. That is, by the way, common sense. If you say there must have been set up as foreign subsidiary or enterprise, naturally, what is an artificial enterprise is completely different from the question, did you really invest capital in another country? So what is a capital investment, and when is a capital investment not really an investment? That's completely different from the question if you set up a genuine foreign company or if the recipient of the capital is an economically active foreign company. Especially in the capital market, there are strangest constructions which are widely used, and so nobody asks for economic reality there. So an artificial capital investment might, for example, be I give capital to a third company and it directly hands that capital back to me. So there one could probably say that was not really investing capital at a foreign place. But artificial nature of a capital investment will be something completely different than in the case of a freedom of establishment case. And they also said that with regard to third countries, there is a different legal framework with regard to tax cooperation, which might justify a difference in the tax treatment. That is something which they already said in other juridical decisions concerning investments in third countries. That's probably to leave a certain flexibility to the fiscal authorities and the fiscal legislation of member states. It does not really stand to reason because one can criticize that very easily, but it's a kind of a loophole which jurisdiction lets to the member states. For this reason, the fundamental freedoms seem to prohibit the application of CFC legislation to major shareholdings in the company of other member states relatively strictly, and seem to prohibit the application of any CFC legislation to portfolio shareholdings in companies of any state, so also third states, provided that the transactions in question are not completely artificial. And that's great, because there you have now a fundamental conflict between what the member states traditionally use as a concept for the tax law, worldwide income taxation, and what the fundamental freedoms of the treaty seem to require. Especially in the field of capital investment, artificial nature cannot be proven that the capital investment is driven mainly by tax motives. Because in the field of capital investment, very often and very traditionally, also in inland cases, it is always accepted that tax advantages are a legitimate or widespread motive for capital investment choices. So that's not an argument. Now, what can we say about what happens in the area of the Anti-Tax Avoidance Directive? In 2016, the EU authorities issued a directive to limit tax saving in international areas. And here they also oblige all the member states of the EU to introduce a CFC regime for at least certain constellations. That is laid down in Articles 7 and 8 of the ATAD. The member states have been given the right by the directive to apply stricter measures, so the ATAD only obliges them to introduce a minimum level of CFC legislation. Now we have something from the EU fundamental freedoms and we have the contents of the directive. Surprisingly now, but following from very basic principles of law, the EU institutions cannot change their own constitution. So they cannot change the contents of the EU treaties by issuing a directive which says something in contrast to the treaty. So insofar, the directive can never allow to undermine the contents of fundamental freedoms as they are laid down in the treaty. So the directive is only binding for the member states, or the directive is binding, but it can only have full legal effect insofar as it does not contradict the treaty rules, so the fundamental freedoms. Now, wherever the directive leaves the member state a choice, the member states are naturally obliged to exercise their options in a way that is fully compatible with the requirements of the fundamental freedoms, so with the principles of non-discrimination and so on. That means when we have the feeling Article 3 says you may introduce stricter measures than the fundamental freedoms say, but during that choice you have to take the fundamental freedoms requirements into consideration and you have to comply with these requirements. So you are not fully free in your choice which stricter measures you want to introduce. You cannot leave the room which the fundamental freedoms have left over for CFC legislations. You can't enter forbidden areas just by pointing to Article 3. Stricter measures are allowed. No, they are only allowed as far as they are not forbidden by higher law. And the higher law is here fundamental freedoms. Okay. So after these details, we can go to more details. The participation threshold. The ATAD only obliges the member states to introduce a CFC legislation if the foreign company is held for more than 50% by one single shareholder or that shareholder's closely related person. So if one single shareholder can directly or indirectly control the majority of the voting rights or more than 50% of the capital. That's 7.1 of the ATAD. For any other constellation, the directive remains silent. So here the member states can include other companies because there they are free how they design their tax law. Naturally, the fundamental freedoms again place certain limits on their free choice. And with regard to the existing case law of the European Court of Justice, the two decisions mainly which I brought forward just some minutes ago, that's pretty improbable or pretty difficult to find further cases which you could include beyond that limits here. The low tax threshold has been formulated in a very complicated way in the directive. In a first approximation, one might say that each member state must at least apply a CFC rule to foreign companies whose tax rate is less than 50% of the corporation tax in the own country of the taxpayer. This rule only applies to participations because the ATAD only applies to corporations. This rule then only applies to participations where the shareholder too is a corporation. If Germany, for example, has a corporation tax of 15%, then the ATAD obliges Germany to introduce at least the CFC legislation to all participations of foreign companies which pay less than 7.5% of corporation tax on their profits. If we set a higher threshold, that might be okay. On the other hand, then we have to justify that choice in the European Court of Justice. If somebody says you are violating the fundamental freedoms by doing more than you need to do, and so you make a stricter restriction than is necessary in your tax system, we will have then to bring arguments that a higher threshold is necessary in our tax system. That is probably possible. The low tax threshold, nevertheless, is expressed more complicated because if you look closer on it, then the rule is that the actual corporation tax paid on the profits by the entity, blah, blah, is lower than the difference between the corporate tax that would have been charged on the entity under the applicable corporation tax system in the member state of the taxpayer and the actual corporation tax paid abroad. It's difficult to imagine the details why that could be formulated this way. I imagine the following things. Imagine you have income from your home state of 100,000 and from the foreign state 100,000, 2%. And the tax rate at home on that would be 30%. You also have income from state A, 100,000, and pay 10%. And in the taxpayer's country, that would be exempted. And income from state B, 200,000, 5%, taxpayer's country, it would be exempt. Then the foreign corporation has the following total tax burden, 22,000. And the total tax which would be due for the taxpayer himself or itself would be 50,000, 52. 52, why? 50 or 50,000, so the difference is 30,000 or 28, whatever it is. So I confused even myself. You see, it's not easy. The tax paid by the foreign corporation is less than the difference. So the ATAD requires CFC legislation. Imagine a constellation like this: income home state 100,000, income foreign state 100,000, income third state B is 2,000. Again, we have in the taxpayer's country twice exemption method. So we have 20% at home. The tax would be this. Total tax if the investment would not be, or the income would be obtained by the taxpayer directly, that would be 42,000, no, 40,000. I seem to be very, very, very faithful to my mistakes. Sorry, I apologize. 40,000, the difference is 18,000, and the difference is, well, not enough, because the tax paid by the foreign entity is in total higher than the tax which would be paid than the difference to the tax at home. And you can concentrate on other things. For example, there is a rule then that foreign permanent establishments which are exempt from tax in the state of the controlled entity are not taken into account during the calculation, which are exempt in the state of the controlled entity, not which would be exempt in the home state of the taxpayer. That was the difference to the constellation before. Again, we have this and this and this. So we have the total tax, we have 12,000. Oh my God, copy and paste it, really a pestilence. We have here 20,000, no, 30,000, and the difference is, that's now completely wrong, 12,000 and 30,000, so the difference is 18. The tax paid by the foreign corporation is more, 30. So ATAD does not require CFC legislation. Other constellations, you have two exempted foreign permanent establishments. So you look only to the tax burden in the country of the foreign company. You compare it with the tax which would be due for the taxpayer, that would be 18, and that's less. The tax paid by the foreign company is less than the difference to what would have been paid if that income had been taxable in the country of the taxpayer. So ATAD requires taxation. So you see, that might be that 3 or 2 states constellation might explain why they explained that CFC threshold in such a complicated way. And it is justified, by the way, to put that all together because, ladies and gentlemen, you can only opt for buying shares in the whole company and not opt to invest in one of the locations alone. So here to compare the overall tax burden with the overall tax which would have been due, that makes sense. Yeah, and there is naturally a warning. The directive is absolutely new. There is no single case gone up to the European Court of Justice. So which interpretations will be chosen in the long run for the directive text is not yet sure. So my interpretation might be wrong. Surprises might show up, or a closer look might show new new possible constellations or conclusions. Again, the member states are free to apply CFC legislation also to constellations with a higher tax level, but then they have to justify their choice when the European Court of Justice tests their choice against the requirements of the fundamental freedoms. So you must be able to justify higher taxation. Now, which types of income are covered under the ATAD? The CFC legislation under the ATAD only extends to non-distributed income of foreign entities. That is in 7.2 ATAD. We have seen that this is only really fitting for systems where you have an indirect tax credit dividend taxation system. But on the other hand, the ATAD just says what the minimum standard is. And so if in the interest of a state, it might also be that you have a classical system and therefore should introduce a CFC legislation also in other constellations to distributed income, then you can decide that on your own. Nevertheless, that really entails the consequence that some states are not really forced to introduce a CFC legislation, although in their system tax saving models might be possible. So the description of the scope of the directive here is rather not perfect. Again, you can say I am free under Article 3 of the ATAD to invoke or to introduce harder measures, but you will have to justify them. Okay. That leaves, or the directive then leaves you with the choice between two approaches. First, there is a catalog of passive income, interest, royalties, dividends, income from selling shares, financial leasing income, insurance, banking, and other financial activities, invoicing companies, and something like that, intra-company trade or so. So the ATAD says passive income is rather capital, intellectual property plus certain business activities which only exist on paper and where you deal with other members of your own group. Then there is, just to make the catalog safe, there is the wholly artificial construction requirement of the ECJ jurisdiction with regard to companies set up in the EU or EEA. This is not required with regard to third countries, because in third countries you have no right to freedom of establishment. So you could do more. The second alternative is asking for the motive and if it's a genuine and non-genuine arrangement. Non-genuine is something where one would not have done the whole thing if it had not been if you had not undertaken the whole maneuver without tax motives. Here the decisive test is therefore if the activity of the company in question happens only on paper. Then you don't need a Schweppes test because it's entirely automatically artificial. There is, by the definition of that CFC application, scope automatically guaranteed that there can be no genuine economic activity behind that construction. That alternative creates legal uncertainty because you will have to face discussions with the fiscal authorities. So it might function as a good deterrent. People are kept away from doing things which are not really convincing. On the other hand, you might risk a court dispute and after 10 or 15 years might win in court. So there is a certain risk for the fiscal administration also if they overdo the practical application of such a rule. Furthermore, you have to decide as a member state about de minimis rules, so the thresholds where you say, if somebody does not more than this or that, then we don't care about the whole thing and renounce on CFC legislation. In case of passive income catalog alternative 1, then the ATAD allows you to renounce on the CFC legislation if that passive income is less than 1/3 of the total income. And certain financial enterprises can also be exempted from the application of CFC rules if less than 1/3 comes from transaction with the shareholder or related companies. Where people apply or member states apply the non-genuine arrangement test, they can renounce on that for small enterprises. Well, ATAD Article 8 then regulates how CFD legislation has to be done. The directive here distinguishes between the two alternatives which we mentioned. In case of catalog of passive income approach, the rules are the income is added as CFC income to the taxable income of the shareholder. It has to be computed according to the rules of the home state of the shareholder. And so you would have to follow the tax accounting rules, let's say, of Germany in order to determine what your share in the CFC income is. Losses shall not be attributed as fictitious additional income. Makes sense. We want to fight tax-saving models and not to bring losses of foreign corporations into the hand of the shareholders, which would never be possible in a genuine inland case. The non-genuine arrangement test, there the rules are the income shall be limited to that amount which is generated through the assets and risks which are connected to significant people functions which are carried out by the controlling company. Congratulations, that sounds a bit abstract. So there one would have to calculate which profit would have been made under genuine conditions. You can have vast disputes about what is going to happen there. So here again, the principal effect seems to be legal uncertainty. If you enter into non-genuine arrangements, there will be a heap of trouble, and that seems to be the practical consequence. Well, yeah, naturally the shareholder only gets to as additional fictitious income that part of the foreign company's income which corresponds to his or her personal participation in that entity. And if you have a group with several levels, then there seems to be a consensus. If, let's say, company A and B and C hold a majority together, then CFC takes place, but every single shareholder pays then CFC tax in its state for its participation. And if now B and C are subsidiaries of A, then state A can also apply a secondary CFC legislation on the shares which ended up, the shares of the profit which ended up in the hands of B and C, but must then credit the taxes which have already been levied as CFC tax on the level of B and C. So might be complicated, but at least works. The income shall be added in that period of the shareholder in which the tax year of the foreign company ends, so directly when the income has been achieved, it will be attributed at the end, closing date of the balance sheet. It will be attributed to the shareholder, so not a day later, not at the earliest day when the income could have been distributed, here on the closing date of the accounting period of the foreign company. Or the tax year or accounting year that might deviate, one would have to interpret that too. Double taxation must be avoided. So taxes paid by the foreign company shall be credited to the tax liability of the shareholder in the shareholder's state of residence or location. The details are determined in accordance with national law, so they are nobody cares about. Measures to avoid double taxation are also where a company distributes profits to the taxpayer, then the amounts of income which were previously subjected to CFC legislation shall then be deducted from the tax base of the dividend income. So the formula again fits perfectly only in a system with an indirect tax credit dividend system. In other cases, it does not really fit. You can nevertheless apply things then in a way which fit other systems too. In cases where an inland shareholder disposes of a share, the gain which is obtained shall be corrected or lowered by any amount which has been previously already included in the tax base of the shareholder. So there is also a method to avoid a double taxation between dividend or current profit taxation and later profit from selling shares and obtaining a higher gain. Yeah, and okay. Now let's have a look to the German CFC rules, which currently exist, but I think that is best reserved for another video, which is going to come soon. Thank you for being faithful to this video till the end. See you back soon.